A company's income statement can show record profits right up until the day the business collapses. The accounting ledgers might look pristine, but beneath the surface, a sudden inability to pay short-term bills acts as an unseen reef, tearing the operational hull wide open. This split-screen chart shows exactly how that divergence happens. On the left, net income climbs steadily, but net income is a byproduct of accrual accounting. It includes promises of future payments and non-cash adjustments. On the right, the actual cash reserves, the money available to settle real-world obligations today, are depleting rapidly to zero, triggering a critical warning state. The International Accounting Standards Board addressed this fatal blind spot by issuing IAS 7. This standard legally requires an entity to provide a historical record of changes in cash and cash equivalents, forcing companies to prove their real-world ability to generate actual liquidity. These historical cash movements act as an unforgiving empirical check. They cut through aggressive revenue recognition and deferred expenses to test the structural financial health and immediate solvency of the enterprise. By stripping away the subjective distortions allowed by varied accounting policies, standardized cash flows reveal the exact, objective financial reality of the business. To ensure this objective reality can be accurately compared across different companies, IAS 7 forces every single cash movement into 3 discrete classifications. This model illustrates the central cash reservoir of an entity connected to 3 primary pipelines: operating activities, investing activities, and financing activities. Notice how the reservoir actively filters the chaotic stream of incoming corporate transactions, forcing each into one of those 3 uniform pipelines. This rigid categorization prevents management from blending disparate activities, like selling off a core factory to cover up a massive shortfall in day-to-day sales. Structuring the data this way gives financial analysts the exact inputs they need to accurately model and compare the present value of the entity's future cash flows. Without this tripartite categorization, analysts would have no reliable way to assess whether a company has the actual liquidity required to adapt to changing opportunities. Before we can track the flow of cash, we have to establish the strict parameters of what legally qualifies as cash under the standard. The baseline definition is straightforward. Cash strictly comprises cash on hand and demand deposits held at financial institutions. But companies also hold capital in secondary vehicles known as cash equivalents. These are short-term, highly liquid investments. To prevent manipulation, IAS 7 applies a strict visual filter gate, as shown here. For an asset to pass through into the cash equivalent vault, it must be readily convertible to a known amount of cash, and it must carry an insignificant risk of a change in value. Short-term treasury bills easily pass through. A long-term stock certificate carries price volatility risk, so it is rejected. The standard enforces a specific timeline for this filter. The asset typically qualifies only if it has a maturity of 3 months or less from the exact date of acquisition. Once assets are inside this vault, any transfers strictly between cash and cash equivalents are explicitly excluded from the main cash flow statement. These internal movements represent standard corporate cash management. They do not constitute operating, investing, or financing activities. By enforcing these rigid boundaries, IAS 7 stops entities from artificially inflating their apparent liquidity by disguising illiquid, risky investments as available capital. The first and most critical pipeline is operating activities. This is the principal revenue-producing engine of the entity. Operating cash flows are the primary indicator of self-sufficiency. They reveal whether the entity can maintain its capabilities, repay its loans, and pay out dividends entirely on its own without requiring continuous outside funding. This schematic maps the standard operational inflows. We see data arrows feeding directly into the central factory engine, representing actual cash receipts from the sale of goods, the rendering of services, and the collection of royalties and commissions. Conversely, the engine requires fuel to run. The outgoing arrows represent strict cash payments to suppliers for raw materials, employee wages, taxes, and other standard operational expenses. IAS 7 permits companies to calculate these operating cash flows using one of 2 approved reporting options, the direct method or the indirect method. The direct method is simple in concept. The entity tallies and discloses the major classes of its gross cash receipts and gross cash payments. The standard explicitly encourages the direct method because itemizing specific cash inflows and outflows provides analysts with superior data for forecasting future cash generation. However, the indirect method is far more common in practice. This comparison matrix highlights the difference. On the left, the direct method works top-down from gross receipts. On the right, the indirect method works bottom-up, starting from the net income reported on the income statement and adjusting that figure for the effects of non-cash transactions and accruals. Under this bottom-up approach, you systematically strip out the accruals. The statement highlights specific adjustment lines, reversing changes made during the period in working capital accounts, like inventories and operating receivables. Regardless of which calculation method is used, the final number is identical. It exposes the true, unmanipulated viability of the core business model. The second pipeline is investing activities. This tracks the acquisition and disposal of long-term assets and external investments, not included in cash equivalents. The analytical purpose of this category is to isolate expenditures made specifically to secure resources intended to generate future income. This structural hierarchy tree illustrates standard investing outflows. We trace heavy capital flowing downwards into major, long-term blocks labeled physical infrastructure, covering property, plant, and equipment, as well as capitalized development costs and subsidiary acquisitions. When a company liquidates these assets, the process reverses. The infrastructure blocks convert back into upward-flowing arrows, representing liquid cash returned to the entity from the sale of property or the disposal of debt instruments held in other companies. IAS 7 also mandates a highly specific disclosure here. The aggregate cash flows arising from either obtaining or losing control of subsidiaries must be reported as a distinct, separate line item within investing activities. Because of this explicit itemization, the investing section clearly reveals whether management is adequately funding its long-term capacity, or if it is cannibalizing its future infrastructure to survive today. The final pipeline is financing activities. These are transactions that alter the size and composition of the entity's contributed equity and its external borrowings. Primary financing inflows occur when the company raises capital. This includes cash proceeds generated from issuing new shares, debentures, corporate bonds, or taking on long-term loans. The primary outflows go in the opposite direction, compensating those external capital providers. This includes cash repayments of borrowed principal, cash spent to acquire the entity's own shares, and dividend payouts. To ensure complete transparency, IAS 7 requires a mandatory disclosure enabling users to evaluate all changes in liabilities arising from financing activities. This vertical capital stack demonstrates those dynamics, with layers of debt and equity physically expanding and contracting as new issuances and cash repayments are processed. This comprehensive view allows analysts to accurately predict future claims on the company's cash by capital providers and directly assess the entity's reliance on external debt. The standard provides strict rules for complex edge cases. Cash flows arising from income taxes are strictly classified as operating activities unless they can be specifically and practically identified with an investing or financing transaction. For foreign currency cash flows, IAS 7 mandates that transactions must be recorded at the exact exchange rate in effect on the specific date the cash flow occurred, blocking the use of period-end rates that obscure the actual value exchanged. Crucially, the standard enforces a total exclusion rule regarding major non-cash transactions. As shown here, an event like a massive debt-to-equity swap is physically extracted out of the main three-pillar statement and pushed downward into a separate disclosure notes section. This rule applies to any transaction that alters the capital structure without actual liquidity changing hands, such as acquiring physical assets by assuming directly related liabilities through a lease, or converting existing debt directly into equity shares. By strictly quarantining these non-cash anomalies to the disclosure section, IAS 7 ensures the core statement remains an unpolluted record of pure liquidity. Ultimately, these three pillars, operating, investing, and financing, do not exist as isolated lists. They form a unified cyclical engine. As this flow map illustrates, external financing capital flows in, converts into investing infrastructure, which in turn powers the operating engine. That engine generates new cash, which cycles back out to satisfy the capital providers. Notice how a single unit of cash can be traced perfectly through this entire map. IAS 7 guarantees that every single dollar entering or leaving the entity is mathematically tracked to its exact functional purpose within this continuous loop. This architecture gives analysts the precise data needed to separate the cash required to maintain current operating capacity from the cash used to increase it. Mastering that distinction empowers you to identify companies that are slowly starving themselves, prioritizing current liquidity distributions and short-term survival over necessary long-term profitability. The IAS 7 Statement of Cash Flows is a regulatory requirement, but its true utility lies in its rigidity. By anchoring corporate reporting to the indisputable reality of cash, it provides the ultimate ground truth map for modeling an enterprise's financial survival.